If you'd like to buy in 2026 or 2027, this video could save you months, if not years. I'm not here to sell you a mortgage today. I'm actually here to show you what you need to do in order to get yourself ready. So it's for people who want to get mortgage ready. By the end of this video, you'll know exactly what you should be working on, in what order, and why most people go down the wrong path. Right, the three main things that people go wrong. They either go to Rightmove, go direct to the bank, or they jump on the mortgage calculator. And this isn't the best place to start. Everything has their pros and cons. So let me try and be positive about some of these things. So going on Rightmove is good for getting an idea of the price of the properties, but then it could be disheartening. Going direct to the bank is never a good idea. I'll tell you why. One, they literally have, each bank has different criteria. You need to know your situation and your criteria to find the right bank for you. So what I've had happen to a lot of my clients is they go to direct to the bank turn them down for whatever reason, and then they feel that they're unmortgageable across the board, which simply isn't true. The mortgage calculator, again, you will always get a range of what you can borrow, if you can borrow at all. And this is because, again, every single bank has different criteria. Some will accept bonuses after a year, some you need to wait 2 years, some you need 2 examples. So if you get if it's quarterly, then as long as you've had 2 quarters you're fine, when some you need 2 annuals and things like that. Some will take overtime into consideration as long as you've done a certain amount, and they'll average it over 3 months, 12 months. Some will take your shift allowance, some will include London waiting. As you can see, there are so many different criterias that if you go to one mortgage calculator, it won't give you the range that you need. So those are kind of the 3 things. So people get overwhelmed by going on Rightmove or Zoopla. People go to directly to the bank they've got their current account with, and then people go and do mortgage calculators. This can create, as I've said, rejection, frustration, and in some situations false hope. You could go and you could get a certain scenario and you think it all looks good, and this has happened with a couple of my clients. They've actually come to me and said, but originally they said I could borrow this and now I can only borrow that. There is a lot when it comes to get mortgage ready, and the thing I always say is, if you're saving for a deposit, that can take a long time, so you might as well work on the getting mortgage ready at the same time. So today I'm going to be talking about the 3 pillars. So that is money management, deposit strategy, and credit profile. Yes, it is also important to understand how the mortgage process and the buying process works, but these are the first ones that you really do need to work on right at the beginning, and you need to be working on them simultaneously. So the first thing is money management. And when I'm talking about money management, I'd like to start off by shocking you a little bit. The lender doesn't just look at your income. So I know that's a little bit of a shock. Everybody just says, oh, I'm on 50,000. It's 4.5 times that, right? Unfortunately, it's not. They do take other things into consideration. Now, the first thing they take into consideration is committed expenses, but they look at it from 2 points of view. So they will be able to run their equivalent of your credit report. So they'll be able to pull down your credit file, and they'll be able to look at all of your balances and your limits. Now, some lenders, they're a bit concerned if you've got a lot of credit limits, even if your credit balances are low, because you have instant access to all of your credit limits. And what clients have done in the past, once they've got the mortgage offer and then they've gone to between the mortgage offer and exchange, they have maxed out their credit cards, buying furniture and getting excited because they're moving into their place. Now, lenders know that that's a possibility, that what they're assessing you on day one may not be the situation by the time you do go to exchange and complete. And that's why, if your limits are high, some lenders will have concerns. Some lenders will have concerns if your balances are high, and then some lenders will have concerns depending on what your monthly commitments are. Then that is things that they can see and can look at and are aware of. Then there are other things that they need to kind of read between the lines on, per se. So the first one is your spending patterns versus your affordability. So, I mean, this is why I always say to my clients, have clean bank statements. And what I mean by that is, when you're actually, they will ask for 90 days, 3 months of bank statements, and they will look at these and they will look for patterns. They will look, do you buy a coffee every day? How much do you spend on your lunch? I once had a client that got a lot of takeaways, and that raised a concern, because it's their spending habits versus their affordability. If the affordability is slightly tight to begin with, and then there's you spend on a regular basis, then that's a concern. They will look at direct debits and standing orders and things like that. So I know a lot of people, and especially in different cultures, they actually give money to family, and it's just easier for them to set up a standing order to pay that out every month. That will reduce your affordability, just to make you aware. Now, I'm not saying that you will be unmortgageable. I'm just making you aware of all the things that they look for. They look if once a month you pay for the gym. They look if you've got Netflix subscriptions. They look at all of this and they work out your spending. A lot of people, I remember when a few years ago, I used to go out to dinner a lot and the cinema and things like that. I don't really do it as much now, but I suppose my bank statement was full of that. People that are always going to the groceries, buying food. Some people go to the groceries every day. Some people go once a month. Some people go every other week. Some people go once a week. And because of that, they actually look at the patterns of what you are spending, because at the end of the day, they need to make sure once you've you've bought that property, you can actually afford to pay the mortgage per month and still pay utility bills and things like that. So the other thing to sort of bear in mind is, you don't always realise how many additional expenses there may be. So for example, if you still live at home with your parents, you may think, oh, okay, as long as I've got enough money to cover the mortgage, I'll be fine. But then there is council tax, there's electricity, there's gas, there's water. There's all those other bills that are coming up. There's building insurance, which is mandatory for mortgages. So there's always all of those things coming up that you need to be aware of. So that's one thing. The other thing is, you may say, well, I will just as I go through my career, I will get pay rises, I will change jobs and they'll pay me more. But then lifestyle could creep in. So lifestyle creep is when, you are on a higher salary, so then you get a nicer car, or you are on a high salary, so you're like, oh, okay, I'm going to buy nicer clothes because I want to go into the office and look a certain way. I want to go out, take my colleagues out to lunch more. I want to, whatever it is. If you have the mindset of, this is how much I have to spend, this is my budget, and even if I get more money, that just means either I can put more money into my deposit when I'm saving for it, or after you've bought the property, you can actually make overpayments on your mortgage. So that's something to consider. Bank statements anxiety. Now, basically, you just need to make sure, and as I mentioned bank statements in quite depth already, the one thing I'd like to add on top of that is it does really worry some people when they try really hard to make those last 3 months look good and then they go back to their normal habits. You need to change your habits because, one, it will help when you're paying your mortgage going forward. You need to be responsible for that. But the other thing is, if once you get your mortgage offer and then the solicitor deals with all of those kind of things and they're looking to exchange contracts and then complete the whole transaction so you fully own it, this could sometimes take a couple of months, and sometimes the lender will ask to see a fresh bank statement or the latest bank statement. So if you've gone back to old habits, you could be in a little bit of trouble. I had another client and they were really borderline whether they wanted to lend them the money or not. So they asked for 12 months bank statements, and that just blew it out of the water. Unfortunately, they'd been really, really good for the last 3 months, but before that they hadn't. Now this is why this is the ideal time, because if you're buying in 2026, 2027 or even 2028, you've got time to build these habits and start managing your money properly. And then that way it isn't just for show for the bank, but it is actually genuinely for a better life, in order for you to, as I mentioned before, pay your mortgage off earlier, be debt free sooner. There's so many things that once you manage your money properly, it gives you a lot less anxiety. So the next one is why I earn enough isn't enough. And that, as I kind of mentioned before, it is all about all the additional costs that are in there. It isn't purely about your income. The other thing is, when you're looking at your income from an employed point of view, then you need to make sure, is there a student loan coming off? How much are you contributing to your pension? Some lenders will add back the pension, some will deduct it and go off your net salary, what you receive when you what your take-home pay is. So you've got your gross income, which some lenders will just do 4 or 5 times that. But then other lenders will be like, no, what is their take-home? And when you've got your gross income, obviously you divide that by 12, and then you will take off, as I mentioned before, pension, if there's any student loans, if they're your tax, income tax, and your national insurance. So that's based on employed individuals. And then also, depending on other bonuses and things that you get, how consistent are they and whether they're willing to consider it. The next thing, when we're looking at self-employed. Now, self-employed, some lenders will do 1 year of accounts, some will do 2, some will do 3, some will do the average. Just bear in mind, if you have an amazing year, what is the next projected? Because they may ask. I've been in situations where someone has done an amazing first year, or they've been sort of this way and then their last year has been amazing. Some lenders, if it's a brand new company, they may accept it. If it's a company that's been going for years and then this is just an amazing year, then have you got new contracts? What can you with your suppliers with your clients in order to prove that income is going to continue? Have you got reasons behind why that was a great year? Have you got projected income coming up? Have you got an accountant that can certify your income? You can get an accountant certificate. So there's a lot of things to think about when you're talking about that kind of thing. So the things that I do talk about a lot, and this is just to make people aware, and I suppose this time of year it's even more prevalent, but a lot of people, yes, I've mentioned subscriptions, but there's a lot of people buying, the buy now, pay later. Now, if this will be my rule of thumb always, if you have the money to buy it, just buy it. If you put it on a credit card, especially an interest-free credit card, that comes across much better than the buy now, pay laters. I once had a client that had 27 buy now, pay laters, and they were all free installments, so they were going to be up soon, but it's just like it didn't need to be done. We had to actually wait till they'd all gone through before we could actually apply. Lenders look at buy now, pay later, and they think to themselves that they see it as a red flag of someone that doesn't know how to manage their money. If you are in your overdraft, I once saw someone that every single month just went into their overdraft because they didn't realise it was an issue, and it's just like, but do you realise you only save money the very first month you go into your overdraft? After that, you're just living in your overdraft. It doesn't actually make a difference. You don't get that extra £500 or £1,000 or whatever it is because you're always in it. So that's something to bear in mind. So if you can get out of your overdraft and stay out of your overdraft, I know things happen, but just try and do that. In fact, know your number, know how much you need every month to cover all your bills now and in the future. And by knowing that, you shouldn't go overdrawn. You just make sure you've got enough money. I once had a client who had 3 separate bank accounts. One was for her day-to-day expenses, one was for her direct debits, and one was for her income. And what she used to do is she used to move her money around, but she didn't like doing direct debits and standing orders, or she didn't think about it. So she used to move them. But then one month she went on holiday and she forgot to move them and everything bounced. Bounced payments, rejected payments on your bank statements really do look bad as well. We were able to explain it, and we were even able to prove that she was on holiday because her bank statement showed, those expenses coming out from abroad, and I was able to sort of turn it around. But you don't need to have that hassle and that stress. Just organise yourself. And you don't need 3 bank accounts. I think that was a little bit. I understand if you've got a current account where your income comes in and where the bills go out, which is a lot easier for lenders because they want to see 3 months bank statements, and they want to show, when they're looking at your bank statements, they're looking for proof of income, and they're also looking for your expenses. To have them all in one place really does help them out. The other thing to consider is obviously to have that savings account, and we'll talk about savings later on, the different types of ways you can save rather than just leaving it in your current account or putting it in an instant saver, which is the lowest interest rate for a savings account. So it's, as I said, it's they really want to know if you can manage your money. I get a lot of my clients and they're like, but I earn enough. My expenses are only 50% of what I earn, and da. But if, as I said with this client, they weren't moving money across and things were bouncing, or sometimes they're in their overdraft, and then one of my clients, they earned really good money, but every month they went into their overdraft. And it's just like, well, the lender I originally put it forward to didn't want to touch it with a barge pole, because they said if they're earning that kind of money, and it was over 100k a year they were on, and they're still in their overdraft every month, there's something going on there. There's more to it, and we don't want to take the risk. And at the end of the day, the banks are running a business. It's literally not, they don't care whether they lend to you or not. There'll always be someone else to lend to. So you need to put your best foot forward, present yourself in the best way, like you would with an interview. But the other thing is, by learning money management, not only do you put your best foot forward on the day, but you do it always, and it can make a huge difference. I once worked with a client, one of my first ever mortgage clients from 5 years ago, and yeah, she wasn't very good with her money at all, and we worked on it together for 6 months before she applied for a mortgage. And she said she learned so much about how to manage her money, and she's so much better with her money now. And that is the whole point, getting those good habits, because they stand you in good stead going forward. And if hiccups do come up along the way, you've got these good habits as a foundation to help. So the next pillar that I wanted to talk about is saving that deposit, having the best deposit strategy. So just saving more isn't, everybody just says, oh, I'll just save more, if I put more in, will that make a difference? The thing is, you need to understand the deposit levels. Now, this is why it's really, really important to understand what you can afford, what you can borrow, I should say, at the beginning. And then there are different deposit levels. Obviously, if you can borrow, say, 200,000, then if you want to put down a 5% deposit, that would be 10,000. If you want to put a 10%, it'd be 20,000. And if you wanted to put, like a 20%, then that would be 40,000. So, and then each of these, they're called loan to values. So basically, a loan to value adds up to 100%. Now, if you've got a 5% deposit, that means your loan to value is 95% because you're borrowing 95% of the mortgage. So your loan, as in how much you're borrowing, to the value, loan to value. So they always add up to 100%. So if you're putting a 5% deposit, your loan to value is 95. If you're putting a 10% deposit, your loan to value is 90. If you're putting the 20% deposit, your loan to value is 80. And why this is important is because, one, it affects the rates that the lender offers you. If, as you can imagine, if you're putting down a 20% deposit, the interest rate is going to be lower than if you're putting down a 5% deposit, because again, bank is a business, so they want to reduce their risk. And if you have a 40% deposit, then that's a 60% loan to value. That's the best interest rates they're going to offer you because it's just such a big deposit. So this is something you need to look at. The other thing is lenders do use stress tests. So what I mean by that is they will look at, so they start off by obviously comparing what you can borrow against the actual interest rate that they're going to be charging you. But then they may add 1 or 2% on top of that because of if the interest rates move, if inflation goes up and the cost of money isn't as much as it was, you still need to make that same mortgage payment, but then all your other bills are going up as well. Have you still got that level of affordability? So at the end of the day, the lender, it's their choice. So they will decide whether they want to lend to you or not. They will decide what works for them. So at the end of the day, some lenders will be like, I know some lenders that will do 100% mortgage. Do you know what I mean? And then there are some lenders that will only lend up to 80%. So 80% loan to value, 20% deposit. So it depends on the lender, it depends on the risk. And that is what will determine the rate. And you've always got to think about the stress test in the background, even though you'll never know what it is because lenders don't tell you. But you need to make sure that it isn't too tight when it comes to what you can afford and what you're borrowing, because there is a stress test. It's like a buffer. So just make sure. And the good thing is you should have a buffer anyway. So it is a good thing. It is a good thing. I just wish they'd tell us what it is. Next, when you're looking at deposits, they do have different feelings about different types of deposits. So if your deposit is equity, for example, and that's if you're, selling a property and there's a difference between what the mortgage is and what the property is, you actually, once they pay off the mortgage, you get some money back. That's what equity is. They will be more favourable to that. If it is personal savings, they will be more favourable to that than if it's a gifted deposit. Now, I understand people are like, but what's the problem with a gifted deposit, which is from a family friend or from a family member? Because even though they say at the time it's a gift, you don't need to pay it back. The bank is always in the background thinking if something comes up and they need that money back, they will ask for that money back. So, and and then that's why they sometimes ask, and I suppose people do find it a bit intrusive. But if you're getting a gifted deposit from whoever you're getting it from, and some lenders will be happy if it's close, you can demonstrate a close relationship with that person. Some, they will literally have to be a blood relative. You know, there are different lenders that will accept different levels of risk, basically. But if you do get a gifted deposit, sometimes they will want just a one-pager. It's called a gift letter that gets filled out, and there's a line, couple of lines at the bottom that say, I'm signing to say that I will not expect this money back. If someone does lend you the deposit, then if it is a loan rather than a gift, then you need to declare that, and that will reduce your expenses, because they will take into consideration that you're paying a loan every single month or whatever. And if they're lending it to you, and some companies do this, they'll lend it to you and give you you know, like a market rate interest rate. That also is taken into consideration. So again, you do need to declare that. So having a loan, even though it's great because you'll get a bigger deposit, but you know, it will affect your affordability, and that will get reduced. With the gifted deposit, one last point on this, depending on how the lender feels about it, they may ask to see the source of their deposit. So I've been in situations where the parents are lending to a child, for example, to an adult child, obviously, and they have asked to see 12 months bank statements from the parents. So some people are happy to give over their bank statements and some aren't. So you need to sort of bear that in mind depending on who the lender is. So deposits aren't just about the number, it's about how you build it up and how it looks. So like in the last example, seeing the bank statements, if it is your savings, they will also ask to see your bank statements and 12 months of them, and they like to see a consistent amount of money being put into the account. Now obviously if it was an inheritance or something like that, I've been in those situations, and you literally just show the relevant bank statement of it coming in. So it could be a year old or 2 years old, but that particular month and year. And then you may have to show some evidence, because solicitors are always involved when it's an inheritance. So you may have a letter or an email that you can provide. But if it is just bog standard savings, which the majority of people are, they do like to see consistent amounts going into the account, and they also they assume it's your savings unless them tell them otherwise. They may and this has also been the case before, they may look at the bank it's coming from. Obviously they'll have the bank statements of the savings account is going to, but they'll want to see the bank it's going from. And if that's your current account and your salary goes in, you pay your bills, and then a portion of it goes over to your savings, all of it matches up because they see the bank statements from the income and the expenses anyway. They see the bank statements from the savings, and you know, everything matches up and everybody's happy. But if it's coming from numerous different bank accounts, they will ask questions and it will be flagged. So just understand the implications of saving a deposit isn't as straightforward. And as I said, saving a deposit is really, really good habit to get into, because every single month you put aside a certain amount of money as a deposit, and who knows, when you actually go to apply for a mortgage, you know, in the next couple of years, and you actually you could use that money to pay the mortgage, because you no longer have to save a deposit and you're already getting into that habit of putting that money aside every month. So it is really, really a good money habit. The next pillar I'd like to talk about is your credit. Now, there are a couple of types of people. There's the type of client I've had that has never had credit in their life. They just pay all their bills on time, and that is that. And then you've got the type of person that uses their credit and knows how to manage it. And then you've got the type of person who overuses their credit. Now, those are kind of the three main people. So when we're talking about credits, or I always say credit rather than credit score. So the history, just quickly, of so originally every time you apply for a form of credit, so this would be a loan, this would be a credit card, anything like that, the way it actually works is that will be registered to a credit agency, and then the credit agency would have this information. They'd call it a credit file. Now this credit file was very detailed and very arduous, I suppose, on the detail, and it was difficult to read, and they wouldn't give access to consumers anyway. And then consumers or customers were like, well, it's my credit commitment, why can't I see? And if they applied for credit and they got rejected, they wouldn't know, and it's just like they wouldn't know why. So then someone created the credit report, which was a user-friendly format for the individual who'd made those made those applications for those credit, to see the credit file, but in a user-friendly form called the credit report. Now, even after that, there were some people that still didn't get it. They still found it was a lot of detail. So then they came up with a traffic light system and then the credit score. Now, depending on your credit agency, be it TransUnion, Equifax or Experian, they have different numbering systems. So 999 may be good on one, but not so good on the other, and vice versa. But with the traffic light system, that is probably one of the best ways of doing it, because if it's red, it's really not good. If it's a dark green, then it is good. So, and then if it's amber, it needs to be worked on. So that is something to be aware of. And when it does come to understanding your credit, it really, really is important, understanding it. And then once you understand it, really, really maintaining it. But at the end of the day, looking at your credit report on a regular basis and double checking the information really, really does make a difference. The whole point of building your credit up is for those people, for example, as I mentioned before, who's never had credit before. If you've never had credit cards, even your phone, you buy in cash, you don't do the contracts that come up, you still live with your parents, you're not utilities or anything like that. Now, what possibly could happen there is, certain banks would want you to put more of a deposit down because they would feel uncomfortable with the fact that you've never had credit before. There is a way around this, of you getting a credit card and just using it for groceries or petrol or whatever your situation is, or even putting your gym subscription on it or Netflix or whatever, and then just paying it off, having the direct debit set up, pay it off in full every single month, and that will build up your credit. And you can do this for I'd say a couple of months to really start making a difference. There are some people, and people get really shocked at this, but some people with a great credit score and they still fail. They still get rejected for a mortgage because there's banks, they do their own internal credit scoring, and two, there are more things to note when you're looking at credit. So, for instance, there's credit utilization. Now, credit utilization is how much credit have you got? So when you're looking at credit utilization, is your credit cards maxed out? So the example I used of managing your credit is just spending a little bit every month and paying off the whole in full. That is fine. Some people, when you're applying for your credit, if you make every single payment, so you never miss a payment, but your credit card is like 90% full, it's 90% maxed out, that will go against you. If you, in fact, some lenders want 25% of your credit limit. Some lenders want 30% of your credit limit, no more than that, not even half of your credit. So it's, obviously if there's a one-off thing that comes up and then you pay it off, it's not a problem, but they really like you not to max out your credit. So that's one thing. So you could have an amazing credit score, you've never missed a payment or had a late payment, so they give you a high credit score, you're using your credit, but because you're maxed out, this makes lenders nervous. So for that reason, they won't lend. I was in this situation once, and she had like a green, she was in the 900s, but she still didn't get the mortgage because she had car finance. That's another thing to look at. Car finance is a concern, and also your debt to income ratio. This comes kind of hand in hand with credit utilization. So on your credit report, not only will you have your credit cards, but you'll also have loans and things like that. Now, what lenders will do is they will add up all of your credit, so that's credit cards, loans, etc., and they will compare it to your income. It has to be 50% or less, because as far as they're concerned, they're going to lend you this massive mortgage and you're already, paying more, nearly as much as what your annual income is. They won't go with that. The other thing is, when you are like, right. The other thing is, what a lot of my clients, I've told people about the debt to income ratio. So what they've immediately done is, with all their credit cards across the board, they've contacted the credit card companies and they've asked the credit card companies to lower their limits so their debt to income ratio is lower. You should actually be paying off your credit cards at the same rate you're lowering the limit, because if you just lower the limit and you don't pay your credit card off, then you may have a better debt to income ratio, but unfortunately you've now maxed out your credit card because you were, say, had 300 on your credit card as opposed to the 1,000 limit, but then you bring down the limit to 500, and then you are at a higher percentage of the balance of the limit, because you've brought down the limit without bringing down the balance. I hope that makes sense. The other thing that they like to look at is whether you've got any late payments, missed payments, and you do need to clarify what this is. Sometimes, if you make a payment, if you set up all your direct debits and everything on the first of the month, and then for some reason they can't take it out the first and they take it mid-month because it's within the same month, it may not be classed as a missed payment. But if you have all your payments due on the 28th, for example, of the month, and then you decide for some reason you can't, it doesn't take those payments, and it doesn't take it till a few days later, you may be in the next month, and then it may be classed as a missed payment. So you just need to be made sure of the timing of that. The other thing is thin files. So if there is nothing in your file, this is a concern. As I said, having a credit card and paying it off makes a difference. Having, a current account, savings account. I've never actually seen a savings account on a credit report, but I have seen people with a couple of current accounts. The other thing is, when people are tidying up their current account, say you had a current account, you've had it for donkey's years, but you don't really use it as much now, and you use a new one because they gave you a deal to switch. Do not cancel that old account, because banks like to know that you've been banking with certain companies for a certain amount of years. Like, I've got a bank account that I had when I turned 18, and I've still got that, even though I don't really use it as much. I put in the odd amount of money and maybe get one direct debit being paid out of it just to keep it alive. But that's because when people say how many years you've been banking, you can really say how many years you've been banking. If you literally switched accounts 3 months ago and you cancel your old account just to tidy things up, and you've only been banking with this one for 3 months, it really doesn't look good. They like you to have a long history with banks. The other thing on credit reports is, addresses are important, dates are important. So just be aware that if they've got your address wrong, there could be a debt linked to that address. So make sure it's fixed. If they've got the dates wrong of where you lived at a property, again, there could be a debt linked to that address. I once had a client and they never bothered to change any of this, and there was a utility bill outstanding from like a year after they'd left the property, but because their name was down on the utility bill, and new tenants, because they were renting and new tenants had moved in, they were like, if they saw the bill, it didn't have their name on it, they just didn't bother to pay it. So he was in real trouble. But then we were able to prove, even though his previous address, it still looked like he lived there, his new address, because he'd registered on the electoral roll, had when he started, So we were able to confirm that he had ended there. So this is why it's good to keep all your tenancy agreements if you're renting and things like that, because then you can prove when you moved out of one property and when you moved into the other. The next thing I wanted to talk about on credit is the financial associates. Now, with the financial associates, so this point you really need to listen to, because this can turn your whole world upside down. You could be going great with your credit, and then all of a sudden someone who you're linked to really isn't doing well with your credit, and it just brings yours down completely. It's like a pack of cards, so just be aware of that. Right, I hope you're all writing notes, and here's the next one. Right, how lenders actually assess you. So they pull everything together, and what I mean by everything is everything. I mean, nowadays lenders can, even when you're filling out your decision in principle mortgage application, they will ask, some will ask, who do you work for, what is the name of the company on the pay slip, and they will be able to verify through, I think it's HMRC, how much you're being paid, and confirm it. So they literally pull everything. There's so much data out there at the moment, but they will look at that. They pull everything together, and then these are the things that they look at. So first is affordability. So they do an affordability assessment, and they do it from the point of view of what is your net salary. How much do you get paid every single month? Is your net salary consistent? Is it different? If you're self-employed, they obviously divide it by 12, take the tax off and look at that. But they really want to know how much is coming in every single month and how much are you spending. So they will look at all of that. When it comes to, as I said before, there is the stress testing. So whatever interest rate you end up getting, they will add a couple of percentages on that and just see if you could still afford it if the mortgage went up. They have got a lot stricter on borrowing than they used to, because people just don't, because of the amount of people that are, unfortunate to say, losing their homes because they just can't afford it because it was too tight. So now they have come up with, if it looks like it's going to be really, really tight, then they're not going to lend you. So that's something to be aware of. And then the other thing to look at is with remortgaging, and doesn't equal first time buying, because when you are remortgaging, they look at you and they assess you on a completely different way. So that is something you definitely need to be aware of. And when it comes to being a first time buyer, they will ask so many questions and get to grips with everything. Remortgaging is completely different. So why timing matters. If you're changing jobs, or if if you've got life changes that are coming up, you need to make the bank aware of all of this. So sometimes it's best either to do it before all of this happens, or to do it 3 months after all of this happens. So then your bank statements are consistent again, and then we know where we are. Obviously, there are things like being on maternity leave and things like that. When that comes to it, as long as they know that you're going back to work on the same hours and the same income, and this might be a HR letter or something like that, then there's less concern. If you do change jobs and it's like a one-off change, and you can explain why, then they're normally all right with that. If you change jobs consistently and they can see, because they do ask for 3 years employment history, if they can see in those 3 years you've had 6 jobs, then, it is all about stability for the lenders, because stability equals less risk. So when we're laying out what order to do it in, so this, and I really think you should make a note of this. So number 1, it is about your stability money habits. And we've talked about this, showing that, how stable you are, what your of what your money habits are to give the lender that level of reassurance. The next step is the building the deposit strategy. Now, at the end of the day, until you've got the stable money habits, you can't allocate a portion of this to the deposit every month. So this is why it is in this order. Then the next is the repairing and strengthening of your credit report. Now, this kind of does go hand in hand, but while you're doing that, you still need to be, and if you make the decision that you want to, start paying off some of your credit cards and things like that, you also, your priority is saving that deposit and then working on your credit. So you just kind of need to navigate that. Then learning about the mortgage process. So this is really important for understanding how it all works. I once had a client come to me and she's just like, oh, my solicitor says that he needs a copy of the mortgage. Can you get me one? And I was just like, what do you mean? She'd already gone as far as having searches done on the property and everything when she didn't even know if she could get a mortgage yet. So she'd already paid the solicitor about £500 in order to do checks on a property that the estate agent had agreed she could buy, but she hadn't actually talked to anybody about how she was going to finance it. In fact, I'm quite surprised the solicitor let her get that far without asking for proof earlier, but obviously that's another situation. But if you don't know the order to do things, it can really muck you up. And, I obviously helped her out and we were able to turn it around quite quickly. But my concern was, that it had fallen out of order. And it really made me realise how important it is that you do actually know the mortgage process, not even the mortgage process, the buying process. With the mortgage process, you do have to work out the affordability. They do review it. You do a full mortgage application, or you get your mortgage advisor to do the full mortgage application. Then they ask to see certain documents. That all gets reviewed. Then they go and value the property. So even though, Rightmove or Zoopla or whatever says it's a certain amount, even though the estate agent says it's a certain amount, even though you offered a certain amount, even though they accepted a certain amount, that still doesn't mean that the bank is going to agree. I was once in a situation where they came back and they valued it 30,000 less than what it was actually worth, and it was being bought from a developer. And what ended up happening was the developer actually gave readjusted the figure and threw in a parking space just to even it out. But the developer's like, this is what I want for it. The first time buyer's like, yeah, sure, let's go for it. And, it's only the bank that was saying it's not worth that much. So they will check, because at the end of the day, they are lending against this property. They don't want to lend against a property that isn't worth as much as you think it is. It's obviously different if it's the other way around, but they do have concerns either way. And then the next thing is, once all your documents stack up, so what your income is, what your expenses are, what the value of the property is, then you get the mortgage offer. And that is when I always tell my clients to instruct the solicitor and get moving on that, because once you've got the mortgage offer, the solicitor can then do all the things they do, searches, inquiries, etc., and then organise when you're going to exchange contracts, which is when you need the building insurance, and when they're going to complete, which is obviously when the estate agents give you the keys and the bank gives you the rest of the money. So exchange is when you have to have the deposit and you give it to your solicitor and they hold it in what's called a client account. And then on completion, which is normally a week later but not always, that's when it's called the drawdown, and the bank draw down the rest of the money. So for example, if you're putting in 10%, they'll draw down the 90%, which is what they agreed that they would lend you, which is detailed in your mortgage offer. So that's how it works. Yeah, and it's always good to speak to a mortgage advisor in different steps of the journey, because at the end of the day, right at the beginning, it might be worth having an initial chat with them so you can find out what you really can afford, so you know what you're basing your deposit on. Some mortgage advisors like myself even review people's credit reports. That's a service that I offer. So you get a report and you get a one-to-one with me where I go through it all. that is something that might be helpful for some, and they can really get an understanding of what they are working on when it comes to their credit report. So if you found this helpful, please subscribe. I'm trying to, by subscribing and liking this video, it gets it out to more people, and more people can sort of learn and get the benefits from it. If you've got any questions or comments, please put it in the chat. And I look forward to seeing you soon. Take care. Bye bye.